Thank you for joining us. The following presentation is from a webinar titled 2015 Pennsylvania Tax Update and Budget Summary, originally produced on July 30th, 2015. The presenters are Jason Skrinak and Michael Levy, both from McKonly Asbury. Enjoy the presentation and visit us online at www.macpas.com for more information about our future events and upcoming webinars.
Good afternoon. My name is Jason Skrinak, and I'm principal here with McKonly Asbury.
Mike Eby, and I'm senior tax manager here at McKonly Asbury.
Thanks for joining us this afternoon. The thought process was we were going to go in great detail with regards to the recently passed budget here in Pennsylvania. Unfortunately, we do not have that. So Mike and I were waiting, and as of half an hour ago, we still don't have a budget. So we're going to bring up current news events today.
I got a couple, Jason. Maybe the Iran nuclear deal, or how about Tom Brady's suspension?
I think those would all be great subjects, right. But I don't think that would qualify for CPE. So unfortunately, you got to listen to us talk, kind of talk about where we're at with what was originally proposed under Governor Wolf's budget earlier this year, some other proposals that were sent out, and kind of taking a look as to where we stand now. After that, we're going to take a look at the 2015 corporate tax year in review, kind of taking it's actually 14-15 year in review. Take a look back over the past year from the Department of Revenue in Pennsylvania, their perspective of hot and current topics. And then we'll follow it up with another Department of Revenue hit is Pennsylvania Top 10 ITS filing tips. The ITS refers to the integrated taxing system, so we'll get into a little bit more detail then. So we'll start off with the next slide. So the budget, where do we stand now? Well, Governor Wolf, when he initially put his budget out, he basically put everything on the table. Sales and use tax, income tax, property tax, anything you could think of was proposed. I thought it was kind of a unique way to start the bargaining. Unfortunately, the legislators kind of are taking the polar opposite. They don't want any kind of tax reform. And that's kind of how we started out the budget process. And usually when you have that wide of a gap, you have some negotiations coming closer together, closer and closer to the due date of the budget. Pennsylvania's budget was due on June 30th. We're in July, and we don't have it, so we are definitely past due. Don't see any end in sight, especially since the General Assembly right now is on vacation to the end of August. So we're nowhere near a budget. But taking a look back,
Jason, when's the last time this has happened?
It has not happened under Corbett's era. That was for sure. Corbett made sure he ran under a budget. He wanted a timely budget every year, which was great for me, great for us, because we had something to talk about in these webinars.
Yes.
Under Rendell, that seemed to be every year it was overdue. Yeah. Right about now, no one's really feeling the pinch too much. Some of my friends over at the state, the Department of Revenue, and some of the legislators and folks in Treasury, they're being inconvenienced right now. Some of those folks are having business expenses that they can't run through. They'll actually have to eat it personally until the budget gets passed, and then hopefully they'll get reimbursed for those monies. But this lasts much past August into September. Then you kind of look at furloughs, employees not getting paid, nothing good with regards to that.
Yeah, and that's been the fear in the past with when the budget hasn't passed is paychecks were withheld until they were paid, and that puts people in a short-term crunch.
Definitely. No one gets too concerned until the paychecks stop coming, and then people start worrying. You'll see at the 2014-15, that was this past year, the budget was $29.4 billion. You'll see the total budget $71.8 billion, but the only thing we really discuss and what you hear in the news is the general fund. So this year, the original budget proposed by Governor Wolf was $29.9 billion, which was just under a 2% increase from last year. What I've been seeing now, it's kind of bumping up over $30 billion, so we'll kind of see where that lands. One thing that we've been talking about last couple of years is the structural deficit. Pennsylvania has been running a structural deficit now for the last several years. When this was proposed, the perceived structural deficit was about $2.3 billion. Recently, the estimates put it more right around $1.3 billion.
Is that related to the economics of the past year, better revenue from tax reporting?
A little bit of that, and I think it was a little bit of Pennsylvania being ultra-conservative. In the past, their estimates were a little higher, and they were never able to meet those estimates. So I think this past year they wanted to be a little more conservative, make sure that they weren't going to get hit up with under revenues under what their estimates were. So I think they became a little more conservative. So that greatly helped the reduce the budget deficit. You'll see in our discussions later on where those additional revenues, what periods those revenues were coming in that were higher than estimates. All right. Okay, we'll go on to the next slide here. You'll see these are the highlights of the initial proposed budget. First and foremost, got all the individuals' attention, at least Pennsylvania individuals' attentions, was the increased personal income tax. Pennsylvania currently has a 3.07% tax rate. The proposed budget put that tax rate at 3.7%. And some of the discussions was, 3.7%, when you look at it across the country, 3.7 is right around the average. It's not, it's not an outlier. It's not way above any of the other states. But I think Mike wants to talk about why that really isn't a good indicator as to where we stand on a national level.
Yeah, I mean, if you look at 3.7% and currently what it is, just over 3%, that is pretty low if you compare it to some of our surrounding states and even across the whole United States. But the way Pennsylvania personal income tax works, it's very different than the way federal income tax works, and a lot of states do piggyback off the federal to some extent. Pennsylvania, you have 8 different income tax buckets. For instance, compensation would be a different bucket than interest, and that's a different bucket than S-corp income. Federal, it's just different lines. So what happens in Pennsylvania is you can't take a loss from one bucket and net that against the income from another bucket. So for instance, if you had compensation and you also had income from a loss from an S-corp, you're not able to take that loss from that S-corp and use it against the income from that from the compensation that you received from that S-corp. Likewise, you may know that you file jointly with a spouse in Pennsylvania, and you think it might be a joint return, but in reality, that's not really how it works. You can't take a loss from a spouse and apply that against income for the other spouse. It's just simply a convenience of being able to report that on the same form, but the calculations are all done separately. And then carryover losses aren't allowed in Pennsylvania as well, which is also an issue for a number of taxpayers. And no deductions. That's a big thing. No itemized deductions, very few deductions. I can think of the 529 plan as being one of the deductions that Pennsylvania has, but very few that federal and other states do allow. So that 3.7 rate actually is much higher if you probably calculated a lot of the things that aren't allowed in Pennsylvania that other states do allow.
Exactly, and that's kind of where we wanted to point out that we're comparing apples to oranges with regards to rates most of the time with Pennsylvania and the other states. The next portion is corporate net income tax rate reduction. Pennsylvania has a 9.99%. It is very important to Pennsylvania that they keep it under 10, so it's 9.99. Pennsylvania has a hard time with regards to attracting business, having business expand here in Pennsylvania. When I talk to some folks outside Pennsylvania at various conferences across the country, we discuss Pennsylvania and talk about, well, why aren't you here? Why don't you come into Pennsylvania? And the first thing off their tongue is your corporate net income tax rate's way too high. Pennsylvania has the highest flat corporate tax rate in the country. There's only one other state out there, Iowa, that has a higher tax rate, but they have a graduated rate. So their highest tax rate is higher than Pennsylvania's, 9.9%. So what Pennsylvania is proposing to do, well, Governor Wolf's budget proposed to do, is to reduce that rate to a 5.99% effective 2016 and to 4.99% effective 1/1 of 2018. And the thought process is there is make Pennsylvania more attractive to work, have businesses relocate here, have businesses expand here, keep businesses here that are already here. So that was the main factor with regards to the rate reduction there, especially when you have a budget deficit and you're talking about rate reductions. The thought process is let's make more and better jobs here in Pennsylvania, increase the sales and use tax for those people spending the dollars, increase the personal income tax for the higher and new wages, and that might offset some of the reduction in the corporate net income tax rate.
Yeah, and I think it brings C Corps a little closer to what S Corps are paying in Pennsylvania. S Corp passes their income onto the individual, and at a 3% or what could be a 3.7% rate, big difference compared to the 10% rate that corporate C corporations are paying. And look at states surrounding Pennsylvania, the personal income tax and the C corp rates tend to be much closer in line with each other.
That's a great point. Great point. Another way that they're going about reducing the tax rate and making sure that it kind of makes sense from a revenue standpoint is also initiating combined reporting here in Pennsylvania. Basically, Pennsylvania is a separate company reporting state for income tax purposes. Each company is looked at separately, first off to determine if they have a filing requirement, and secondly to calculate the tax. In the past and currently, being a separate company reporting state, there's some planning opportunities that you can do. Some of them, some of them have a bad stigma associated with it. The one being the Delaware Investment Holding Company. You hear horror stories about how much money Pennsylvania is losing out to these Delaware holding companies. I don't think that's the case anymore. 2015, a lot of the states out there have done away with the benefits of running a Delaware Investment Holding Company. Pennsylvania also, 2 years ago, they enacted legislation and with regards to an add-back. I'm not sure if you want to kind of talk about the add-back a little bit. Okay. Well, basically, the add-back is the intercompany expenses associated with intangibles. Pennsylvania is requiring, effective this year, 1/1 of 2015, requiring companies to add back intercompany expenses on intangibles that do not have a valid business purpose and are not made at arm's length. So that's trying to clean up the stigma of the rogue tax preparer out there creating these rogue entities to get away with not paying tax here in Pennsylvania. It's not as common, it's not as prevalent as it was in the past when I first started my career.
Do you believe the add-back has adequately addressed
I think it has. I think that it's going to get rid of all of the sham transactions that are out there. These shell corporations which have no business purpose, there's no meat to this entity. They basically running out of a corporate desk. They just have a file cabinet and that's all they have. There's always entities out there that are running intercompany transactions that have a true and valid business purpose, and it just makes sense from a business perspective to run these intercompany transactions for various purposes.
Sure.
Another thing that scares the heck out of me with combined reporting, and we'll talk about the integrated taxing system down the road, but to change taxpayers, tax practitioners, I think everyone's familiar with combined reporting. There should be no hard task to get everyone up to speed on creating new forms and whatnot. I think that the task would be to get the Department of Revenue up to speed, not from a knowledge standpoint, not from the individuals, but from their computer systems. Switching from a whole new taxing regime and changing it from the Pennsylvania computer system they have now and what they're running with and what we'll be discussing later, I could see being very detrimental. So that's kind of talking about how PA is trying to attract business with the governor's proposal for corporate net income tax. And Mike has a great point on the next topic.
Well, the state's looking to reduce or actually make the limitation harder for to be able to use net operating losses from previous years. And this is really going the opposite way of where we had been coming. They had been reducing the limitations the past few years. It used to be about 3 years ago where you could only use $3 million or the greater of that, or 12.5% of your taxable income in the current year. And then they gradually got up to 20% or $5 million. And we're going the right way because not many states limit how you can use your NOL from a previous year. And part of the way of being able to pay for a reduced corporate tax rate for C Corps is to put more restrictions on the utilization of the NOL. And it really does kill startups, and that's where you're going to incur a lot of NOLs in your first few years. If they're not able to utilize these within the 3 or 4 years following when they had these losses, they might not be around to be able to utilize them in 15 or 20 years. And just companies that are having bad revenue years, they're unable to use them right away because of these restrictions.
Yeah, so it's kind of counterintuitive to the rate reduction. The rate reduction is looking to attract business, and then the NOL restrictions is kind of putting another handcuff on businesses here in PA. So it's kind of interesting. Another item that I'm sure most people have heard out there is increasing the sales and use tax rate. Under Governor Wolf's proposal, the sales tax rate for Pennsylvania, which is currently 6%, 1% for Allegheny County, so it would be 7% in Allegheny, and Philadelphia, which is currently at 8%, so they have a 2% additional tax rate in Philadelphia. Governor Wolf is talking about increasing the tax from that 6 to a 6.6% statewide, and Allegheny County would still have that additional 1%, but Philadelphia, they would be willing to cap theirs at 8%.
Yeah, so essentially they would lower that one to 1.4% additional compared to the 2% now.
So I understand why they're talking about doing that. The revenues that they're looking to cut the structural deficit in addition to funding some other programs that were involved in the budget, it makes sense with regards to the increase of the tax rate. One thing that I'm pretty opposed against is the next item, which is the increase of the sales and use tax base. So,
yeah, I think the rates, I think people can probably get over that aspect of it. That doesn't scare as many people as increasing the base. What they're proposing is increasing what was taxable to a lot of services that are currently not taxable, as well as a few other products that there currently are exemptions for in Pennsylvania. I just wanted to read off a couple things on the list of proposed services that the Pennsylvania would start taxing: transportation services, real estate brokerage services, legal services, one we really don't like, accounting services, waste collection services, spectator sports. Another one I wouldn't personally like, but and some property too that currently there are exemptions for or exclusions. Candy and gum would be taxable. Personal hygiene products would be taxable. Non-prescription drugs would become taxable. There are still a few things that would stay exempt. Kind of the big three in Pennsylvania: food, clothing, and prescription drugs, and then of course purchases from nonprofits. But you could see where when you start increasing taxes on services that weren't previously taxable, it's going to hurt a lot of different purchases. Now, to avoid what you commonly hear as tax pyramiding, basically a business performing a service for another business who then sells at retail to another company. You can see where sales tax could get stacked on pretty quickly. So there will be, for services, certain services that they're proposing, like the accounting and legal services, a business-to-business exemption, which obviously we would be in favor for. But if you look at something like accounting services, if you're paying tax on your tax prep fees, you're, of course, paying taxes for income taxes, and then you're getting taxed for sales tax on the preparation fee. So, it's not quite double taxation, but in some ways
a lot like double taxation.
Yeah, exactly.
Putting a tax on a federal, state, and local requirement, something that's required by law, just does not seem patently fair. So I'll step off my soapbox for that, but I just don't agree with that. Up next is property tax relief. Take a step back to last year. Pennsylvania, some of the proposed legislation out there was House Bill 1776, and a lot of my family and friends out there were very, very excited about that because they basically said, we're getting rid of property tax. Well, that's great. However, did it really get rid of property tax? Under the proposal, they would have pretty much done the same things with increasing sales tax rate, increasing the personal income tax rate, and their thought process was that they were going to reduce property taxes. Well, let's pump the brakes on that. We're not going to be reducing property taxes for any school that has outstanding debt. They can still, have their property tax. So I'm not sure about most of you, but I know the school districts around me pretty much all have debt. So that pretty much means that you're still going to have a property tax for those school districts. In addition, the proposal was sent to the Independent Fiscal Office for them to, run the numbers, see, the increased revenues, does it make sense to reduce the property tax by that much? And the answer was a resounding no. The increased revenues from the sales tax and PIT nowhere came near offsetting the reduced revenues associated with getting rid of the property tax. And another thing that kind of scared me with regards to that is that you're taking the property tax monies coming into the individual, the localities, and you're moving that along to the state. So Pennsylvania gets the monies, and then they have to trickle it down to the localities. Whereas how it is now, property tax is going straight to the localities. They have a little more authority to get the money, a little more streamlined process of getting that money. So that was last year. What Governor Wolf proposed was basically what people heard was decrease property tax by 50%. There's a little footnote there. No one that I know, and no one in my family was going to get that increase, that 50% reduction, because these were specifically for localities that were distressed. So folks that lived in the city of Harrisburg or maybe up in Scranton. He specifically targeted distressed localities to get this tax break. Once again, that just didn't seem fair to me. There's another couple proposals out there, but one that kind of made sense to me was kind of taking the property tax rent rebate program and expanding it. So individuals with lower income that could use the property and rent rebate more would get a larger portion of that. And older Pennsylvanians that are having a hard time keeping up with the increased property taxes, having a hard time staying in their homes, trying to target them a little bit more, in addition to having a broad-based reduction in property tax across the board. That seems a lot more fair to me. It seems to make a lot more sense. And the one proposal was very interesting because it was tied directly to the revenues associated with the sales tax increase and the PIT increase. So in periods in which the economy was doing well and Pennsylvania was receiving more revenues for those two programs, for the sales and use tax and PIT increases, they would directly offset additional property tax reductions. So that benefit right there is kind of nice. I really wanted to make sure that the localities kind of get handcuffed a little bit where they can't just increase their rates. Fine, we're going to reduce the assessment, or vice versa. We're going to give you a reduced assessment. Well, fine, we'll increase the rate. Well, no. We'll switch that. We're going to reduce the rate. Well, then we'll just increase the assessment. There's opportunities for the local jurisdictions to play with the numbers, and I just want to make sure that that's covered in any property tax reform. So all for property tax reform done in the right way.
Yeah, and I really, the big fear in all of this is that Pennsylvanians are going to have a cost of living increase because of the personal income tax, because of the sales and use tax rates going up. but not many people are going to be able to experience the property tax relief associated with that. And that's kind of the message to get out there, that it's going to be a lot of bad, and the good's not going to outweigh that necessarily on the current proposal.
The one thing that scared the heck out of me is I was in one of the legislators' office kind of talking about this last year, and they were talking about the proposal, and he informed me that everyone's a winner. And you can't have that with taxes. You're going to have people coming out ahead, you're going to have people coming out behind. You're never going to have something where everyone's a winner. So that kind of put a slant in my eye that I didn't think that this was going to work. Some other budget items that were thrown out there was increased cigarette tax. No one really ever has issues with regards to taxing the sin taxes, cigarette, alcohol, gambling. People's vices, they have no problems taxing that. And the new bank shares tax rate. They're talking about increasing the bank shares tax rate.
And Jason, one that's not on there because it's not really a budget proposal, but it was actually emphasized in the governor's speech back in, I believe, March when he proposed it. It was cap stock is definitely set to go away in 2015. It's finally at its lowest rate of 0.45 mils. And if you watched Wolf's presentation, that was the only thing that I think both sides actually agreed on and got a standing ovation.
Yeah, I think both sides stood up and applauded that.
So they've been talking about that for years.
Are you going to say 100% done, Mike?
I'm going to say 99.8, and I think that's pretty high.
Yeah.
If I was gambling, man, I would take those odds.
I fell for that 2 years ago. I said in a presentation, I talked about capital stock is dead. A week later, they not only put it back on track for that current year, but they said we're going to have it next year too. So I'm not going to hold my breath. They've been phasing out the phase-out of the original phase-out of the capital stock foreign franchise tax for a long time. But we'll see what happens. So other items that we're hearing back and forth, cause of concerns, bargaining chips, what have you, is the state pension reform. Talked about the $1.3 billion deficit that we're currently facing. A lot of that has to do with the current year portion of the unfunded liabilities for the pension funds for PSERS and CERS, basically the teachers and state workers. They are currently under a defined benefit plan, and we probably wouldn't be in as much of a mess if in the good days in which the economy was doing really well, if they would have kept up with putting money into these funds the way they were supposed to do. However, we're experiencing between 5 to 10% annual increases to our economy, and the thought process was, well, let's spend the money now. We're getting these rates of returns. We'll keep doing this in the future. We'll keep getting these, high single to double-digit rates of returns. There should be no problem catching that fund back up. Well, that's fine if you can keep the economy growing like that, but it didn't happen. Hit a dip, hit a recession, and the monies that were not put back into the system, we're feeling the pain now. So that's one bargaining chip that I think is going to happen. There's going to be some additional reforms to the pension reform. Liquor sales reform. They're getting better here in Pennsylvania. I know there's my local supermarket, so I take my kids to go shopping, and after they're done opening everything they could possibly open, throwing anything sugary into the cart, and they're done screaming and yelling, I stop by right next to the checkout at the supermarket that you can buy a six-pack, and I really need that six-pack after that grocery store experience. It's great. I live pretty close to Hershey Park, so you get a lot of tourists coming in, and I love it. I see their confused looks coming out of our local convenience store, the Turkey Hill or Sheetz, and I could tell the out-of-towners because they look so confused. And then they ask me, where can I get a six-pack? Where can I get a case of beer? Where can I get a bottle of wine? I said, well, it depends on what you want. If you want the bottle of wine, you have to go to the liquor store. If you want a six-pack, you have to go to a bar. If you want a case of beer, you have to go to the distributorship. So I think liquor sales reform is going to be changing a little bit. I'm not sure how much the reform will go, but I think it's one thing that we'll see a little bit of movement on. One thing is severance or driller's tax. That's not going away. I think that we'll have something on that. Original proposal was a 5% severance tax. Pretty much any state that has severance and drilling extraction in their state has a severance tax. So it'd be just a matter of getting Pennsylvania lined up with the other states. And the drillers they're not paying any other tax here in PA, so I think that they should be taxed on something.
You're kind of setting me up, Jason, on that one, because that, no matter what however you would view the severance tax, one just misconception that's out there is that these drillers don't pay any taxes. And that's just not true. They're here just like any other business. They're paying, if they're a flow through, they're paying personal income taxes and withholding wages. They're also paying C Corp or cap stock taxes if they're a corporation, and they also pay a one-time extraction fee currently as well. So they are paying taxes. Again, depending, it doesn't matter how you view it. If the severance tax is good or bad. But that is definitely a misconception you see on some of these commercials.
All right, some of the other high topics we've seen out there, combined reporting, talked about that earlier. I'm not really sure it has the legs, especially when we start talking about the integrated taxing system. We'll see where that goes. One thing I wanted to throw out there was the vendor discount for sales and use taxes. This was a big item last year. For the honor and privilege of collecting and remitting sales tax, Pennsylvania provided that the taxpayer is entitled to a 1% discount on the taxes collected and paid if it was timely collected and timely paid to PA. Very generous. A lot of other states have a vendor's discounts, but it's limited. So Pennsylvania was looking to limit this last year, and the limit was pretty small. It's maybe a couple $100 per return filed, so nowhere near the discounts some of the large retailers were getting in the past. The large retailers didn't like that idea, and they definitely reached out to their local congressman and talked to them, so that went away rather quickly last year. I haven't heard anything about that this year, but who knows? I think there's going to be a lot of wheeling and dealing here once they get back to Harrisburg. But that might be something that pops up again. Tax on smokeless tobacco, sales tax on smokeless tobacco, another sin tax. It just makes sense, especially if you're taxing cigarettes already. Online gaming, Pennsylvania dipped their toe in the water with regards to gambling when they started having casinos here. And they did rather well, as you can tell by going to Atlantic City, and a lot of the hotels and casinos out there aren't doing as well as before Pennsylvania started their own casino business. I think the next step is Pennsylvania sees that online gaming, there's a lot of online gambling out there. There's a lot of money associated with that. So the legalization of that here in Pennsylvania would provide the opportunity for Pennsylvania to tax it.
We got a comment, Jason, that liquor sales reform is the best thing you've said today. So I don't know if that says anything about our presentation or
or our audience. So up next is taking a look at the corporate tax year in review. And like I said earlier, this was pulled from the Pennsylvania Department of Revenues. We get twice a month. Well, I'm sorry, once every 2 months we get an update from them. Just got one this morning from them. And they provide a lot of good information. It's quick, easy, and it hits the topics pretty well. So the one from this time last year that came out was the budget summary that was passed under Governor Corbett. Talking about Governor Corbett, when he originally ran, and then under his original platform, he said that there was going to be no new or increased Pennsylvania taxes. I didn't quite understand how he could do that. He did it, though. the budgets were passed without raising Pennsylvania taxes, although some could say that the impact fee was a tax. Fee and tax are separate, two different words, so technically I guess it wasn't a tax. Semantics. But some of the things that Governor Corbett did last budget was some one-time fixes. He took some monies from some funds, some grant funds that were out there that weren't being used too much, and moved it over into the general fund. There was a bank shares tax fix. There were some new casinos, so they got some license fees here in PA. But the one thing I thought was interesting that Mike's going to discuss briefly is the changes that he made to the abandoned unclaimed property.
Right. He was able to get, as you said, a one-time bump up with abandoned and unclaimed property without raising any type of tax or rates with that. Basically, he took everything that was a dormancy period reporting requirement of 5 years and changed that to 3 years. And a dormancy period is basically an owner who has, or a business that has property that belongs to someone else, and they are unable to track down the owner, the rightful owner to it. After 5 years of that property being dormant, they have to remit that to the state. So by changing that reporting requirement from 5 years to 3 years, that was able to, revenue was able to collect a little more funds one time, or initially at least. One important thing to know about that did not apply to payroll checks. That was and is still 2 years dormancy period for reporting that stuff.
The next item under that was tips to avoid corporate tax processing errors. We discussed that a little further later on in our presentation. And when I was talking about the general fund, the corporate deficit that we're talking about, we're reducing from about 2.3 to 1.3 billion. Last year, the general fund totaled $28.6 billion, and it was about $500 million under estimate. So that's where I was talking about them being a little more conservative going forward, I think, with regards to their estimates. The next month, or 2 months, would be August, September 14. The Department of Revenue expands the property tax rebate program. In the past, you would have to be alive for the entire year in order to be able to be eligible for property tax rebate. They changed that, so if you're alive during the year past, you would still be eligible for a portion of your property tax. Well, you wouldn't be eligible for it. You're not around anymore. Your spouse or the trust filing on your behalf would be able to get that rebate on your behalf. There's a debut of the new Department of Revenue website. Mike laughs at me because I don't like change. He asked me this morning. He goes,
You also don't like computers. So
I don't like computers. I don't like technology. It's not so much I don't like it. It does not like me. So Mike was talking about there's nothing really changed with the website. Well, I still like the old one better. So I'm getting more and more used to the new website, and I can find the information very easily. It's actually a great source for us. We go to the website all the time. There's a lot of good information out there.
Yeah, I think the Department of Revenue, we do a lot of state research for many different states, and I would say our Pennsylvania one is one of the best ones. And probably their best feature is that they're very responsive on their Q&A on their website. So, to get a formal ruling, we need to go and get a private letter ruling, but those can take a while. So for something that's kind of a one-off question, you can get a pretty decent response from them, and it's usually in a few days. Yep,
I definitely agree. The one thing I laugh about is the Philadelphia cigarette tax. So Philadelphia now charges $2 per pack of cigarettes, and that was effective at the end of 2014. And they basically estimated the revenues by taking the amount of cigarettes sold last year and adding $2 to each pack sold. Unfortunately, some people did not realize that you can leave the city of Philadelphia to buy cigarettes. So I'd be very curious to see what their estimates were versus what the actual revenues received were. And right across the river is Delaware. No sales tax. And this kind of shows you the general fund was $4 billion collected, which was slightly under what they're expecting to collect, but nothing to be too concerned about. Next month are October and November. property tax rebate deadline approaching. It was due by the end of the year. The business tax transitions to the integrated taxing system. Mike says I don't like technology, so when I first started working with the Department of Revenue, about 20 years ago, started talking to them, and they kept talking about COBOL, and I had no idea what the heck they were talking about until they told me that's the computer system they're running on. I'm like, oh, okay. And kept hearing horror stories, and then I finally asked, I said, well, why is it so bad? It's so bad because it's so old, and no one's around anymore to fix the system once it's broke. So a couple years ago, there was a big push to get revenue some money to upgrade their systems. It was very well needed. 2 years ago, they started off with the sales and use tax system. They're upgrading that. Last year, they did corporate taxes, and then this year, they were supposed to start personal income tax. Well, sales and use tax came through. There's a lot of griping, a lot of delays, but you kind of expect that when you're going to a new system. Things will be better for corporate tax. Well, they implemented corporate tax. Things aren't much better with regards to corporate tax. We have a story in our office that one of our clients has $1 million of credits on their account. I don't think that's due them, and I'm having a hard time explaining that. I don't think it's really ours. I think there's something out there it's being double counted. Maybe you gave us an extra $1 million from someone else's account, but I'd be more than happy to cash the check for our client if we can get reassurances from revenue that they will never ask for that back. Still waiting for that phone call back from revenue, but I doubt I'm going to hear from them. So all the issues we had with sales and use tax and corporate tax, we were telling revenue, and I think revenue finally saw the light of day, that if you do this to the individuals, if you start messing with the individuals' monies, they're going to be coming after you with pitchforks and torches coming down to revenue. You don't mess with the individual's money. They can accept it if you're messing with the corporate dollars, but don't mess with my money. So hopefully we'll get the tax folks kind of steering the ship as opposed to the third party that came in from an IT perspective and was telling the tax folks what they needed, and the tax folks kind of got left with what the IT folks said they needed. So it's not really working out very well.
I know we have some Department of Revenue personnel listening in, also some practitioners from other firms. And, talking with Department of Revenue people, they know the system's bad, and it's not their fault. So always...
They're just as frustrated as us.
Yeah, I encourage you to not take your frustration out on them, because they are really trying to do their best to
definitely
get information correct.
All right. Still got a lot of slides here, so we're going to start going through some of these a little more quicker. December 14, January 15 came out with bonus depreciation clarification. Mike, I don't think it was much.
Yeah, nothing really new. I think that the confusing thing is that C Corps and pass-through entities have different rules. C Corps have kind of a strange calculation of a 3/7 add back, and it's on the form Rev 799. So there's just some tips on how to properly account for that for C Corps. And the big thing to always take away from that and the clarification is that the calculation will never add up correctly. So whenever the asset's done being depreciated for federal purposes, you can have a one-time catch-up for Pennsylvania. And some people forget that that takes place.
At the end of the useful life, right?
Exactly.
Yeah. Sales and use tax desk audit was announced. That's being handled by Pennsylvania's pass-through department. There's not much information out there. Just kind of be aware that it's out there and it exists. I think that what they're basically looking at are past filers that stopped filing for some reason. They're looking to see why. Or businesses that they usually expect to receive sales and use tax returns, and they're not getting them from these entities. So I think that's going to be the first, kind of sweep. Try to get the low-hanging fruit on that one. General fund, you'll see that for this period, we're $103 million over estimates. So that's kind of where we're building up to that reduction of the deficit for this year. Next up, we have February, March. Talked about Governor Wolf's proposed budget announcement. We went over that. Pennsylvania joins the MultiState Tax Commission. The MultiState Tax Commission is a group of states. There's 24 other states that are involved in the joint audit program. MTC, the MultiState Tax Commission, offers 2 joint audit programs, one for corporate and one for sales and use tax. Pennsylvania joined up for corporate tax purposes. So the MTC is basically made up of these various states entering in, choosing entities in which they want to audit. So they choose the taxpayer to audit, and then they have their MTC auditor go out and audit these taxpayers on behalf of the various states. So it's basically 12 to 24 state audit all in one shot. The one thing to be aware of is you're not going to get 12 to 24 audit assessments all at one time. They would stagger that. But MTC works with the taxpayer, comes up with an audit, provides it to the various states, and then it's in the state's hands, whether they want to issue an assessment based upon the audit findings or if they just want to just kind of ignore it, or maybe they want to do their own audit, which is not a good it's not a wise thing to do. It's kind of recreating the overall expense. The audit was already done once by the MTC. If you go back and redo an audit, you're wasting the taxpayer's time, and you're just duplicating efforts there. I actually have an article out there on the CPA Journal with regards to the MultiState Tax Commission if you want some additional information on that. Department of Revenue eliminates billing notices. I think Pennsylvania had way too many notices going out and confusing people, so reducing one of the notices I think is a good idea. You see the budget was $377.6 million over estimates for the year up to this period. So next month, April, May, additional electronic filing and payment options, more money towards property tax rebate, and you'll see here we're almost up to $570 million over the estimate from prior year. So that's kind of where you saw the reduction in the budget deficit. So up next, this past year I actually had 2 corporate notices, one for bank shares tax. Kind of took a look out there. I didn't see anyone out there in the banking industry. If anyone has questions on that, please reach out to me. And then a corporate tax bulletin on the application and sales of restricted tax credits.
Yeah, and this is a really good bulletin. It's essentially just an update to the bulletin that came out 2011-03, so really not many changes in that other than there's at least one new credit, historic preservation tax credit. It just provides different treatments, and there's different restrictions for each restricted credit, depending on if it's the NAP or the R&D or the REAP credit. So that's just a really good guide on knowing how those credits can be utilized and sold.
And good news, we are halfway done with our presentation. I'm just kidding.
We got 10 people leave.
We got a couple more minutes left here, and we haven't gotten any questions, so we're just going to keep rolling right through here. And Mike's going to give just a couple updates with regards to the Department of Revenue's top 10 filing tips.
Yeah, we're going to go really quick through this, as Jason said. First one's kind of pretty obvious, you would think, based on the heading of use the correct form. If you dig down deep, it basically, the RCT 101s used to be a year-by-year form, but now they are, the specific year would not be filled in. It would be filled in by the taxpayer software. And that allows for changes for fiscal year taxpayers depending on what the year is, and the rates have changed for cap stock, so that allows that to properly count for that. Properly submitting amended returns. It's important if you're doing amended return, don't just submit the section that you're amending, but actually submit the entire return again including the section that you're amending.
Including any boxes that were checked originally. You want to make sure it's scrubbed down and completed just like the original. Exactly.
Don't use letters when there should be in cells that actually should be numbers. For instance, if you have apportionment, if you put none in Pennsylvania or not applicable, the Department of Revenue's system is going to actually kick that out and say it's 100%. So you could get a pretty large tax bill when you really should have had no tax bill.
Yeah.
So,
and 0 over 0 is 100%.
Yes.
So it's 0 over 1 is 0 for Pennsylvania.
Just make sure, as Jason said, use your checkboxes appropriately both on amended and original returns. If you're a holding company, make sure you check that box, or if you use that 10% rate, it will kick that out and not allow that. Provide all information about the taxpayer correctly, including the corporate tax ID, EIN, anything with the address. Also, for the capital stock tax, make sure that the history of earnings, which is the top part of that calculation, is accurately represents the history of the book earnings of the company. Don't make changes to that history from year to year, because that'll automatically trigger a notice with the Department of Revenue. Don't have gaps in between the years. What you need to report is your most recent 5 years, and if you have a couple short years in there that would make it go over 5 years, then it would be your most complete period up until 5 years.
Hopefully you don't have to worry about this after the next year.
And then make sure you claim bonus depreciation properly, as we talked about before. The Rev 799 is somewhat of a complicated calculation, but that's one that the Department of Revenue will send notices out for. We talked about apportionments, and Jason said the 0-0. Yeah, don't do that. Make sure that the denominator actually adds up to what the number on the federal return would be. Just skipping down, if you have a partnership activity, if you have a partnership that owns another partnership, make sure you take that partnership share of assets and payroll and include that in the apportionment for the owning partnership.
I'm impressed, Mike. We actually got over 50 minutes of information about the budget without having a budget. Just think what we could do if we actually had a budget.
Probably have to make it a 2-hour CP. We'll send it back to Tyler, and we do have, looks like, 1 or 2 questions here, and then he'll throw it back to us.
All right, so we're kind of over our time slot here, but we did have one major concern that I kind of want to throw out there. The question was whether, with the reforms to the sales and use tax base, does that have any implications with regards to the manufacturing or processing exemption?
Yeah, and that currently under the proposed budget, that is not on the table for removal, so that should be protected, and you don't really see that coming back on.
I think they're pretty much safe, because that's one area that Pennsylvania, well, any state is trying to increase the manufacturing jobs in their state. It's a good job. It's a well-paying job. So that's one thing that I don't see changing anytime soon.
Right. Same with processors as well, and certain purchases made by government entities and nonprofits. And then we got another question about Tom Brady's suspension, but that really was a joke. We are not experts on that.
As long as he's out for the season opener against the Steelers, I'm all for it. Well, thank you, everyone, for taking your time out of your day to join us, and we look forward to talking to you soon. If anyone has questions or concerns, our contact information is right there. Please feel free to reach out to us. Thanks a lot.
Thanks, everyone.
Thank you once again for joining us for this presentation produced by McKonly Asbury. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn more about our upcoming events by visiting us at www.macpas.com. Thanks again, and have a great day.